Hello guys, fairbinaryoptions.com, and like tweeted earlier on the official Twitter account at FairBinary, we are starting a Binary Options Academy. It is being called basically an educational site for our website www.fairbinaryoptions.com, and we'll cover there the trading principles to watch or to master when you trade binary options. And of course we are going to focus on the currency markets, as the majority of the trading assets offered by all these binary options brokers are basically based on the currency markets and the currency pairs. We will cover basic trading principles, basic trading shapes, and we'll go then more advanced into Elliott Wave's theory, into trend line support resistance, and explaining from the beginning until the more complicated theories, everything that is related to trading. We'll have two different strategies and patterns being described on a weekly basis, so we'll build there a nice educational purpose with the let's say with the final scope, or with the final goal, that you as a trader will become more familiar with what it means to trade binary options and what should you look for when trading. Now the first series, the first educational series, is going to deal with head and shoulders, and the reason we started with head and shoulder is because this is a reversal pattern. Now, a reversal pattern means that the head and shoulder comes after a bullish trend or a trend that moves to the upside. As you can see here, the pattern appears and then price reverses, as you can see, to the downside here. It is exactly the same situation on a downward trend. After a downward trend, an inverted head and shoulder is being formed and price is breaking into the other direction. Both are being reversal patterns. We're going to cover only head and shoulders here, but all the principles to be covered here are going to be valid, or are valid, for trading the inverse head and shoulder as well. Now, a head and shoulder pattern looks like this. So price coming from the downside, like mentioned earlier, makes a small consolidation here as being called as the left shoulder. Then price spikes to the upside. This would be called the head. Then of course we have another trying for the bull, or another try for bulls to overcome the highs. And then of course this would be the right shoulder. So this is how any textbook material will depict or will show you a head and shoulder pattern. Now of course, like mentioned earlier, that this is the head. This would be called the left shoulder. And of course, that this would be the right shoulder. Now, any head and shoulder pattern comes with the measure move, and the measure move goes from the distance from the head to the neckline. So you have to imagine a person, a human person. You just draw a neckline. By the time the left shoulder and the right shoulder is completed, like this would be the neckline. Let me change the color for it. Let's make it straight black. This would be the neckline. And any head and shoulder, like mentioned earlier, comes with the measure move. The measure move goes from taking the distance, measuring the distance from the head to the neckline, and then projecting this move at the moment the neckline is being broken. And this would be the measured move for the head and shoulder pattern. So this is the measure. Now, exactly the same it is being valid So exactly the same, it is being valid if you are having an inverse head and shoulder. Basically, price coming from after a downward trend makes the inverse head and shoulder, so everything that's here but twisted the other way around, and the measure move will be to the upside on that situation. When you trade binary options and you see such a pattern, the head and shoulder pattern, and you know that this is a reversal pattern, then the logical thing to do after the head is completed and price is consolidating on the right shoulder is to buy put options, because it would imply that price goes to the downside. By buying put options, you are looking for price at the expiration date to be lower than your striking price, and it depends very much on the time frame that you are trading. This is, as you can see, the Great Britain pound US dollar, but this is a 4-hour chart. So on such a time frame, the expiration date to be considered would be end of week expiration date, or even end of month expiration date, if you are finding this pattern on the second half of the trading month. But if you happen to find a head and shoulder or an inverse head and shoulder pattern on the 1-hour chart or on the 5-minute chart, then of course the expiration date differs very much, and you can actually engage into trading short-term binary options with this kind of pattern. Moving forward, what you have here, as mentioned earlier, is the Great Britain pound US dollar, and on the next recording I will show you how to apply this theory. This is the textbook material, so how to apply this theory on a classical example on this Great Britain pound US dollar, and what to look for by the time price the pattern has the head completed. Remember, the head means a spike to the upside that is quickly retraced, and basically from this moment of time we should look at the left shoulder, look at the characteristics of a left shoulder, and try to apply it on the right shoulder. Ideally, but this is not mandatory, after the neckline it is being broken, price comes and retests it and then goes for the measure move. But again, this is not mandatory, as sometimes traders just wait for the retesting of the neckline, but this one never comes. So let's move on with the second part and try to apply this thing to the price above there. So stay tuned, please.